What's up, YouTube? It's Chris Sain here. It's your boy coming at you with another 10x stock, yo. Woo! Welcome back to Strongman Personal Finance. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. And holy crap, did I witness the most insane thing I've ever seen on YouTube. That's right, ladies and gentlemen. Chris Sain is pumping one of the most sketchy private equity investing, weird share diluting, dividend paying with no operating cash flow company that I've ever freaking seen in my entire life. So let's go pull up Chris Sain's video. What's up? And then we're going to go look at this weird company. And I had to do some research on this because I'd never heard of this crap before. So here's that. What's up, Chris Sain? What's up, bro? In this video, he said, I bought 100 shares of this. You should too. High dividend, high growth dividend investing. So apparently, and I don't want to play this recording because number one, I don't want to hear a stupid voice. But number two, I actually have audio issues with playing other YouTube videos. However, in this video, and you can start it at around the 2-minute mark, he says that you can buy a dividend stock at any price. It doesn't matter what you pay for the price because you get dividends, bro. No, that's not how it freaking works. Actually, the higher the price, the lower the dividend yield. Moron. You should value every single company the same. Are you getting a good price for the future projected earnings of the company? Excuse me here. But this guy's such a moron that it doesn't matter what you pay for. It doesn't matter what you pay for the stock, bro. It doesn't matter. What a freaking joke. What a moron. Of course, that's why he has 472,000 subscribers. Doing the Chris Sain voice really messes up my throat. So here we can see he put in $4,000 and he bought 180 shares of CSWC. Now, I don't know what he said about it, but the name of the company is Capital Southwest Corporation. So let's go read a little bit about this company. Overview. We are an internally managed, close-in, non-diversified, I always love to see that, investment company that is elected to be regulated as a BDC under the 1940 Act. What is a BDC? Let's go look. The 1, 2, 3s of BDCs. Income-oriented investors seeking access to debt and equity of private companies may want to revisit the market segment known as business development companies. So the BDC structure is a joke. I don't want to say it. Was created in 1980. Okay. For U.S. tax purposes, BDCs typically elect to be treated as regulated investment companies, which are generally not subject to entity-level taxes on distributed income. That means the dividends you get are going to be taxed at your highest marginal tax rate. There's a difference between C corporations that are taxed and then pay a dividend. Those can be qualified dividends. When you get money from a BDC, you're going to be paying the highest freaking tax rate. So if you go and invest in something like CSCW, the dividends are so tax inefficient, they're freaking nuts. U.S. law requires that BDCs invest in no more than 70% of total assets in qualifying assets. These are defined as private U.S. companies or public U.S. companies with less than $250 million in market capitalization. So basically, these BDCs go and invest in companies that are a bunch of basically privately owned penny stocks is what they are. They aren't traded on any exchange. So if you want access to the private equity market, you can invest in a BDC. That sounds not risky at all. So jumping back to their 10K, this is a BDC. Remember, their dividends are passed through and they're taxed at your highest marginal tax rate. Our target companies have annual earnings before interest, taxes, depreciation, and amortization, EBITDA. Remember, EBITDA is trash. It's just stupid made-up character. I'm just going to subtract out interest, taxes, depreciation, amortization, and selling expenses. I'm just going to make up something else. EBITDAs. Between $3 and $20 million. Okay, so they EBITDA. So let's look a little bit more and see the management's discussion and analysis. And I'm going to show you something really sketchy on the financial statements. I mean, maybe I don't understand this business model that much, but there's some sketchy freaking stuff going on here. So let's see. They actually said how many. Here it is. Investment portfolio composition. Blah, 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 blah. They said how many companies they had invested in. Where is it at? I believe they are currently invested in roughly 73 different companies, which is decently diversified. But basically what they're doing is they're issuing debt. They're taking money and they're lending it to private, like really low, businesses that are struggling, trying to, become bigger and survive. They're lending money and potentially buying stock in these companies that are on the up and up, potentially. Now, it's high risk because they're basically investing in a bunch of penny stocks, okay? So here's our investment activity. During the year of March 31st, 2022, we made new debt investments in 34 portfolio companies. Follow-on debt investments, so they're issuing debt, in 14 portfolio companies, and equity investments, that's buying, privately held stock, in 15 new and 6 existing portfolio companies. So, sounds really sketchy to me. I mean, I'm not saying these companies are bad, but basically you have to rely on these managers to, sieve through all the crap and junk in the private equity market. I'm sure there's some good stuff and good money to be made out there, but there's also a lot of trash. There's a reason a lot of these companies aren't publicly traded. So here we can see, okay, they have 72 total companies in their portfolio. Not crazy low, but I like to be a little bit more diversified, okay? So let's go and see some sketchy stuff on the financial statements, okay? So the first thing I want to show you is their statement of cash flows. This is actually the main thing that caught my eye. So you look at the company, right? We see they generally have positive net income. They're profitable, right? Look at their operating cash flow. Negative, 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 negative. And okay, they had positive operating cash flow in 2014. I'm not sure, maybe I don't understand how the model works, but when you have negative operating cash flow, your business is burning cash every single year. So how do you get cash? Well, you have to issue shares or you have to go into debt. So we can see negative, 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 negative on operating. We go down to investing. Oh, they're paying dividends. That's weird. Share issuance. They're issuing shares every single year to raise money. Okay, I guess the shares decreased somehow in 2017. What, $460,000 worth? They're issuing debt, borrowing money. So they're borrowing money, they're issuing shares, and they're taking that money and they're going and lending that to up and coming businesses or buying stock in these businesses. So at the end of the day, they're taking money from new investors and they're going into debt and they're turning around and paying out a dividend. So to me, that's just like a massive red flag. Okay. When you don't have positive operating cash flow and you don't have positive free cash flow, what are you doing? Why are you paying a dividend? What? That doesn't make any freaking sense. That's just, it's almost like a Ponzi scheme. Because think about it. How does a company get money? Well, I mean, they're making money from when they buy the debt in the business, in some new and upcoming business on the private market, they're paying interest, blah, 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 blah. Or, the fair value of the business they're invested in, which depends on how they value it. I mean, that's also sketchy. How do they value these businesses? How do they record this income? Are they valuing it correctly? Are the businesses they own actually worth what they're saying they're worth? I don't know. Do you know? You'd have to do tons of research and actually be able to really go into their portfolio to understand. I have no idea. But at the end of the day, they're just taking money. It's like a Ponzi scheme. They're taking money from new investors and then they're paying out a dividend to older investors. It seems like a Ponzi scheme to me. You look at the operating cash flow, they're not making any cash from that. They're burning cash every single freaking year. It's so freaking sketchy. So, it's got a high dividend. Oh, yeah, it's got a high dividend, guys. What is their dividend yield? Oh, yeah, I'm so smart because I'm Sain. And, yeah. Let's see, dividend yield, 11%, 10%, 8%, 23%. Good Lord. Good Lord. Let's see how the stock price is done. 5 years. Okay. So basically, before the pandemic, it was $22. Okay. They had I guess, decent growth, you could call it. Then it freaking crashed. And now it's basically at its pre-pandemic levels. So I don't even know what to think about this company. Like, this is the oddest thing to me. Like, this dividend yield, it's like fake. It's like a Ponzi scheme. They're just borrowing money from new investors and going into debt. Maybe I'm misreading something. Now, regarding the taxation thing, they actually published this on their website. Tax status of distributions. These dividends are from the company's ordinary net investment income and net short capital gains for the year. No, I think they're actually from, because I looked at your operating cash flow. They're actually from your freaking new investors and you going into debt. This type of dividend is to be reported on your tax return as ordinary income. So up to 37% plus net investment income tax, potentially, plus freaking state tax. So, like if me, Kevin, bought this, he'd be paying over 50% of this in tax. Ordinary dividend distributions from an RIC generally do not qualify for the preferential tax rate. So this 11, let's say most people are in the 22% tax bracket. So if you're getting an 11% dividend, your real dividend, this is not even factoring state, is 8.58%. Now, if you factor in state and net investment income tax, it's even higher. And if you're in the highest tax bracket and you have 11%, what is that? Was it 64 or 63? You're getting basically a 7% dividend. That's freaking trash. There's something really sketchy going on here. Maybe I'm not understanding it. But do you think Chris Sain has done any of this kind of due diligence at all? I have a lot of questions about it. I don't understand what's going on here. Why do you have negative cash flow in your operations? You're paying a dividend and you're funding that dividend with new investors. Really, 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 really sketchy to me. You think Chris Sain looked into this? Oh, yeah, I did. Yeah, what's up, YouTube? 472,000 subscribers, YouTube. This is trash. I would not touch this freaking company with a 10-foot pole. Very, very sketchy. What's up? What's up? Yeah, I went pretty ham with that thumbnail. I think dividend investing is justified if you buy a company at a good price and have millions of dollars to be able to live off dividends. That's a niche case. But don't buy this company for dividends. I'm telling you that. There's something really weird. They're buying private businesses and they're lending money with your money in private businesses. How do you know what they're buying? I mean, how do you know what they're telling you is the truth? It's a bunch of sketchy companies with not a lot of information out there. I'm not saying that all the companies are sketchy, but I'm saying, like, how do you know how the companies, what if they're actually buying good companies? It's sketchy as hell. Goblin by Oblin. Wait, people are buying into non-diversified private equity with no research, not even waiting to hear what's a bridge somewhere they're getting equity in. I mean, I won't say watch a Chris Sain video. Look at that dividend, guys. Oh, yeah. What's up? They'll just go buy it because it's got a high dividend, bro. Don't worry about the taxes, whatever. I should call Chris Sain's emergency $1,000 per hour hotline to verify your analysis is correct. Yeah, I'm sure he has a great bull thesis. So I spent about 15 minutes researching this, and I learned about the tax status. It's very tax inefficient. I learned a little bit about the business. I mean, they're profitable on a GAAP basis, but on a cash flow basis, they're burning money, and they get new cash by taking in new investors. It's a Ponzi scheme. They take it from the new people, they give it to the dividend to the old people. maybe I'm reading it wrong. I don't know. It's a legit Ponzi. It looks like it. I'm not even joking. They pay the dividend to everyone. It's like 9%. Yeah, but a dividend doesn't mean you're getting a 9% return. The stock price could go down 10% and you get a 9% return. Guess what? You got a 9% dividend. You got a negative 1% return. Good job. And then you pay taxes on that dividend at your higher tax rate. These are not preferentially taxed. What if Strong Baby's first words are tattoo Jeff? All right, well, that's it. I mean, if you see something wrong with what I looked at, I mean, I just looked at the cash flow statement. I read a little bit about the business. It seems weird to me. I don't understand it. But it seems like something Michael Scott would get into. But yeah, that's my thoughts. Chris Sain's a moron. No, you can buy dividend stocks at any price. It doesn't matter. So if AT&T goes up to $100,000 per share tomorrow, You can just buy AT&T because it doesn't matter. All right. Talk to you later. Cheers.